That's two separate parts. I guess on the economy, initially it was underrated. Now at this point it's probably overrated. Now it's kind of the long-term aspects like the debt levels that were already there kind of playing out. So it was kind of like the pin that popped it. Government response, a lot of it was state response. So a lot of people think of it as the federal government doing its own thing, whereas really a lot of the response was state-based. I think, some states did better than others. I think the federal level was not great for a lot of reasons.
In an interview with Equity Mates, Lyn Alden discusses the government's policy response to the impact of COVID-19 on the US economy, breaking it down into two distinct phases. Initially, she notes that the economic impact of the pandemic was underrated, implying that the severity of the situation wasn't fully recognized or acknowledged at the outset. This likely refers to the sudden and unprecedented nature of the crisis, catching policymakers and the public off guard. Lyn Alden engages in a nuanced discussion regarding the government's policy response to the impact of COVID-19 on the US economy. To fully understand her insights, it's crucial to contextualize her remarks within the broader economic challenges posed by the pandemic. As the public health crisis resulting from the COVID-19 pandemic evolves, the economic consequences are becoming increasingly clear. Alden's assertion that the economic impact was initially underrated aligns with the rapid and necessary decisions made to bring parts of the economy to a standstill. The severity of the crisis, with businesses shutting down and millions experiencing reduced income, underscores the unprecedented challenges faced by policymakers and the urgent need for effective responses. Alden's shift in perspective, indicating that the government's response might be overrated at this point, gains significance when considered alongside the evolving economic landscape. The introduction of additional information regarding the federal policy response emphasizes that the initial focus was on public health, with measures like funding for health agencies and the Families First Coronavirus Response Act. However, as noted, these steps were insufficient to address the comprehensive economic fallout necessitated by policies aimed at preserving lives in the short term. Additional insights support Alden's claim that more needs to be done and provide a detailed roadmap for a robust fiscal response. This includes income support for households, broader and continuous access to safety net programs, incentives for employers to avoid layoffs, loans to small businesses, and measures to stimulate the economy. The proposed actions are substantiated by concrete examples, such as providing cash aid to current holders of the electronic benefits transfer system and offering relief to firms based on maintaining payroll. Alden's nuanced view on state responses gains depth when considering the multifaceted fiscal relief proposals, emphasizing the need for immediate and sustained measures. The call for more expansive stimulus support, based on economic data, aligns with the recognition that a deeper recession might unfold, necessitating adaptive policies with automatic triggers.
Like I said before, I'm pretty bullish on Bitcoin over the next year and a half. I think that's an interesting alternative asset class. I think this is going to be a period where having diversification globally and in terms of alternative assets could be pretty important. And historically, when sovereign debt, like in the US and many other countries, is very high, usually bonds don't do very well over the subsequent decades. So they often fail to keep up with inflation. And so depending on an investor's time horizon, they can make sense in a portfolio to some degree. I use, say, cash and T-bills as a counter-cyclical, investment approach. So when I think equity markets are overbought, I shift a little bit out of equities and into bonds. And then we get, if we get an equity sell-off, I put some of those bonds back into the market. So I use bonds like a little bit of a shock absorber, but I'd be cautious about being overweight bonds in this kind of debt heavy environment that often has some degree of sovereign debt crisis, even if it just takes the form of bonds just failing to keep up with inflation for a long period of time. Sure. So I originally covered Bitcoin back in 2017 because I got a lot of emails from my readers to cover it. So I covered it in autumn of 2017 after it had that very big run up. And, I analyzed it from a couple different perspectives. One of them was as a medium of exchange. The other one was as a store of value. And I took a couple different approaches and determined that as a medium of exchange, it was probably overvalued. As a store of value, it had a lot of potential. But because of the big run up, it had a lot of positive sentiment and was probably near term overpriced. I also was concerned about Bitcoin's network effect because that was kind of a strong alt season. So Bitcoin's share of the market fell to under 40%, and there was a risk. And then also, Bitcoin and Bitcoin Cash split, and there was this. Saw a risk of dilution. So even if a lot of money flows into the crypto space, but it kind of gets distributed among many different currencies, it doesn't necessarily concentrate and build a strong network effect. So I took no position, and of course Bitcoin, briefly soared, hit 20,000, and then collapsed, and then it's been in this big volatile consolidation period for the past couple years. And so when we had the March sell-off, I saw Bitcoin fall along with many other assets, including precious metals. And in April, in my premium service, we went long Bitcoin, just under 7,000. And then I published that big piece in July. Bitcoin was a little bit over 9,000 then. And so a couple different reasons. One is most of Bitcoin's historical price bullishness tends to happen in the first half of each halving cycle. So if you look at the launch cycle, and then roughly every 4 years when it undergoes a new supply halving, most of the price appreciation for Bitcoin tends to happen in the first 2 years of each of those cycles, whereas the second 2 years tend to be periods of either crashes and then consolidations. So it's kind of like if Bitcoin's going to have a run, this is kind of the time period where it would likely happen. And that's because if demand stays steady and a large percentage of the existing user base are holding their Bitcoin, which they are, we have data on that, and new supply is cut in half, basically means that there's still a persistent amount of demand chasing kind of a smaller new supply of kind of freely tradable coins. And so that tends to push the price up. And then once it pushes the price up, you get momentum traders coming on board to push the price up even further. And then you get like the kind of the bad traders, like the fear of missing out traders piling in and causing a top. So that cycle has happened 3 times before, the launch cycle and then 2 halvings. So I think there's a good chance that's going to happen again over the next about 1.5 to 2 years. So given where we are in kind of the Bitcoin halving cycle, given the fact that Bitcoin has kind of regained pretty strong network effect, its place in the ecosystem is very strong. Thousands and thousands of altcoins have come along, and some of them have kind of novel use cases, but none of them have really kind of replaced Bitcoin as kind of digital gold, as a perceived store of value, as kind of a settlement asset. And then lastly, just the macro landscape. So with all of this, the things I've talked about, like in this kind of long-term debt cycle unfolding, it's usually relieved with currency devaluation. And that tends to be very bad for some segments of society and good for other segments of society. But either way, if you're, say, a big bond investor, it's not good for you. Whereas a small allocation to something like Bitcoin, as well as allocations to other alternatives like precious metals, can defend against that sort of risk. So I do think that Bitcoin, especially in this kind of part of the halving cycle, deserves a place in many portfolios.
Lyn Alden's positive outlook on Bitcoin is complemented by recent market developments. The cryptocurrency has experienced a remarkable surge, gaining approximately 40% in value over the past month. This rally has been attributed to heightened excitement surrounding the launch of the first US Bitcoin futures exchange-traded fund and growing concerns about inflation, both of which have fueled investor interest. The Bitcoin price in 2021, which reached an all-time high of around $67,000, reflects a substantial increase, surpassing its previous peak in April by $2,000 per Bitcoin. This surge has captured the attention of both retail and institutional investors, contributing to the positive sentiment surrounding Bitcoin. Adding further support to Alden's perspective are predictions from Bitcoin and cryptocurrency experts. Their forecast suggests that the Bitcoin price will continue to climb, potentially reaching highs of around $80,000 by the end of 2021. Looking ahead, the predictions extend to a surge to $250,000 by 2025 and an ambitious $5 million per Bitcoin by 2030. While this bullish momentum is evident, it's essential to note varying opinions within the cryptocurrency space. Some cautionary voices warn of the possibility of a significant market pullback, with 52% of respondents in a survey expressing concerns about Bitcoin losing more than half of its value in a short period. However, amidst these concerns, there's prevailing optimism that the current bull run for Bitcoin could be more sustained, lasting until the second half of 2021 at the very least. Bitcoin's potential to compete with gold as a store of value is also a point of discussion, with ongoing debates about its ability to attract market share away from traditional precious metals. The influx of institutional investors into the crypto space adds weight to the argument that Bitcoin could continue to grow as a safe haven asset. Predictions also touch upon regulatory considerations, as central banks and governments closely monitor the surging market cap of Bitcoin. The potential introduction of new regulations could impact the cryptocurrency landscape, emphasizing the need for increased attention to compliance and taxation for Bitcoin holders.
So I think that's been an issue that's building for a while. So back when we implemented the global reserve currency as currency structured, there were economists like Robert Triffin and Keynes that warned against that this structure would eventually lead to large trade deficits. And that's exactly what happened, because basically what the reserve currency does is it creates a lot of external demand for it, which pushes up the valuation. So with most countries, when they have, say, a trade deficit, eventually there's some sort of crisis, their currency weakens somewhat, and it makes their import power weaker, and it makes their export competitiveness stronger. So that kind of normalizes over time. Whereas with the US, because we have so much extra demand for our currency, our trade deficit never normalizes. So we just have kind of massive deficits over decades. And that really started in the early 1970s with the petrodollar system. So the version of the current system as currently constructed. And also after World War II, the US was nearly 40% of global GDP, because it was kind of like, the last man standing. So as Europe and Japan recovered, and then as emerging markets, especially China, grew in prevalence, the US is now, about 20% of world GDP, or even less than that on a purchasing power parity basis. We're no longer the biggest commodity importer, that's China. And so basically, we've had to run consistent trade deficits, and we've basically exported a lot of our industrial base. So we have one of the most service-based economies in the world, and we don't really make a lot of our own things, even more so than some of our other developed peers, like say Japan or Germany. So it's not just like all developed countries shifted their manufacturing to emerging markets. They all did so at different degrees. So a lot of advanced nations still have kind of skilled manufacturing, whereas the United States kind of exported a greater share of that. And so we had a lot of benefits in the beginning from that system, but over the past few decades, a lot of our working class citizens have really suffered from that, because those jobs have been impacted the most. So that's contributed to the fact that America has among the highest wealth concentration in the developed world, compared to many of our developed peers. And it's a very kind of separated society because of that, because there are some of us that got rather wealthy from the system, whereas many people, particularly in the lower half of the income spectrum, were kind of more negatively impacted by it, especially in recent decades. Going forward, I think we're probably going to see more multipolar currency system. So there's no country now that has anywhere like the status that the United States had after World War II, right? There's no country kind of large enough that its currency can be the one currency that all commodity pricing in the world happens in, like the dollar. Including the United States anymore. We're just not really big enough. So we're probably, moving more and more towards kind of a, several top currencies. So, Russia's pricing some of its energy in euros now. China and Russia between themselves are doing more trade outside of their dollar network, right? So they've rapidly decreased their dollar usage in the past 2 years. And I just think we're kind of headed towards a more multipolar currency world. And I think eventually the United States currency is going to weaken, but it's unfortunately kind of a necessary effect to happen if the US wants to kind of rebuild its industrial base.
The near 10% drop in the value of the US dollar since its March high has sparked two prevailing narratives. One, emphasizing short-term benefits for the US economy, and the other expressing concerns over the dollar's fragile status as the world's reserve currency. Lyn Alden's discussion on the structural issues surrounding the US dollar's role in the world aligns with the latter narrative, asserting that the longer-term consensus view is less positive for the US. The factors contributing to the recent depreciation of the dollar are multifaceted. The US Federal Reserve's monetary policy response to the worsening economic outlook has played a crucial role, causing a decline in income for dollar-denominated safe havens. As the attractiveness of US-based investments diminishes, there has been a notable shift in holdings towards emerging markets and Europe. Additionally, indicators suggest lower capital inflows into the United States, with foreign house purchases decreasing, partly due to inward-looking policies and trade measures. Alden's perspective on the reactions of different economies to the dollar's depreciation adds depth to the analysis. While some developing countries welcome the reversal as it helps alleviate higher import prices, advanced economies like Japan and the Eurozone express concerns over the impact on their economic recovery from from the COVID-19 shock. The discussion contextualizes the global repercussions of the changing value of the US dollar, providing a nuanced understanding of how different nations perceive and respond to this phenomenon. Alden explains the short-term positive view within the US regarding the dollar's depreciation through economic textbooks. A weakening dollar benefits US producers' international and domestic competitiveness, making the country more attractive for foreign investors and tourism. The positive effects extend to US stock and corporate bond markets, emphasizing the immediate benefits for the economy. However, Alden aligns with the longer-term consensus view, expressing worries that sustained dollar depreciation could further erode its global status. The weakening of the dollar's credibility, attributed to US policies over the past few years, raises concerns about the potential loss of the exorbitant privilege associated with issuing the world's main reserve currency. Alden's insights provide a critical analysis of the potential consequences for the US in the evolving global economic landscape. Alden challenges the emerging consensus around the short-term and long-term narratives. The discussion underscores the interconnectedness of global economic factors and highlights the intricate dynamics that shape the value and role of the US dollar in the international monetary system. If you found this analysis intriguing, explore more of Lyn Alden's work for in-depth insights into economic trends, financial markets, and the evolving geopolitical landscape. Don't forget to like this video, subscribe for more engaging discussions, and hit the notification bell to stay updated with our latest content. Thank you for joining us in this exploration of economic complexities, and we look forward to having you back for future discussions. Until next time, stay curious and stay informed.